Let me tell you a secret. Not the kind you sign NDAs to protect, and not the kind you overhear in boardrooms whispered through layers of legal polish. I'm here talking about the kind of secret that hides in plain sight. A niche in real estate, quietly powerful, structurally sound, almost completely ignored by institutions. High yield, low visibility, deeply misunderstood. Not because it's risky, but because it's too unglamorous. No rooftop decks, no press releases, no renderings designed to seduce. It's not the kind of real estate that wins awards, but the kind that quietly sends distributions month after month, year after year. And today I want to show it to you. But first, let's talk about the real pain. If you're here, it's probably because you've reached a point in your life where the real risk is no longer not having enough. The risk is not knowing what to do with what you have. You've accumulated capital from an exit, a peak, a long season of hard-earned trust, and now that capital is sitting and it's exposed, not just to inflation, but to noise. Every week, a new pitch arrives, a passive short-term rental deal that looks more like a hospitality hustle, a ground-up development in a city you barely visit, a 5-year fund that locks up your capital and gives you no say, just a slick PDF. And underneath all of it, a quiet question starts to grow. Is it actually safe, or am I just playing dress up with someone else's speculation? Because you're not chasing returns, you're chasing reliability. You want cash flow you can depend on, not just in a spreadsheet, but in your actual life. You want to invest like a principal, not like a hobbyist. And I've been there. After exiting my last business, I committed fully to US real estate, not through traditional channels like REITs or retail funds, but directly, deal by deal with a family office lens. And what I found changed everything. The best performing assets in my portfolio weren't the ones with the fanciest addresses. They weren't even on the radar of the major institutions. But the cash flow, the risk adjusted return, the predictability, extraordinary. In this video, I'm going to walk you through one of those corners of the market, an overlooked pocket of real estate where we've consistently found double-digit cash yields, downside protection built into the structure, and an edge, not just informational, but behavioral. Here's how we'll do it. First, I'll show you what this asset class is and why so few people are talking about it. Then I'll break down how we structure these deals to exact consistent tax-efficient income. And finally, I'll explain why this niche has remained under the radar and how the invisibility is your advantage. These aren't theories. These are the exact deals I've put my own capital into. The ones I've invited a small circle of trusted co-investors to join. And by the end, you'll understand something most investors never realize. That most reliable real estate cash flow isn't in the spotlight. It's in the shadows, quietly compounding from the allocators who know how to look. Let's begin. If you told me 5 years ago that some of the most resilient, high-yielding assets in my real estate portfolio would be small retail centers in towns most investors have never heard of, I would have smiled politely and moved on. But I would have been wrong, because what I've learned after allocating capital with structure first lens is that not all returns are created equal, and the market doesn't always price that difference correctly. There's a segment of US real estate that remains invisible to the institutional eye, not because it's flawed, but because it's small, stable, and doesn't signal status. It's called secondary retail in sub-institutional markets. And in our experience, it quietly produces some of the highest cash-on-cash returns with some of the lowest behavioral volatility. Let me show you how and what I mean. We got a call from a broker in the Southeast. Not just a high-flying name, it was someone that we knew from the ground. He had a deal, a 35,000 square foot retail strip center in a tertiary town. The tenants were Dollar Tree, a regional pharmacy, and a mix of mom and pop operators. It had long leases, no vacancies, 9.2% cap rate. To the average institutional fund, it isn't even a blip in the radar. No national anchors, no core market, no programmatic scale. But that's what exactly why I call it our attention. We ran it through the Infinity engine, and it flagged some strong local employment, minimal new construction, and an undersupplied retail corridor. Our underwriting team confirmed that leases were below market and escalations were in place, and physical plant was clean. We didn't take common equity. We structured a preferred equity position, a 10% current pay. The equity kicker above a fixed hurdle. Full downside model stress tested against tenant churn and rent reversion. That deal has never missed a distribution, not once. So why does this niche, forgotten, unglamorous, underpriced, work so well? Let's unpack it. First, the yield premium that nobody competes. For most institutions, they have a floor. If the deal is under 15, 20, or maybe even 50 million, it doesn't get looked at. That leaves a wide middle market opportunity where pricing and inefficiencies and cap rates are fat. We've routinely seen 200 to 300 basis points spread compared to institutional retail. Two, essential embedded tenants. These tenants are chasing the next lifestyle center. They're dry cleaners, local taquerias, dental offices. Their customer base is the neighborhood. Their risk tolerance is low. Their stickiness is high. Third, smaller ops, lower capex. Unlike multifamily, you're not cycling through units or managing amenities. Unlike office, you're not carrying TI packages or full floors of vacancies. These assets are lean, triple net leases push maintenance to the tenants. We focus on assets where structure does the work, not active management. 4. Behavioral durability. During COVID, some of our trophy retail saw abatements, delays, occupancy drops. But these little centers, they keep humming because they serve something institutions don't model. Life as it's actually lived. People still need prescriptions, haircuts, taquitos, and when things get uncertain, they trade down, not out. But a great asset class isn't enough. How you enter matters more. Here's how we structure these deals, not just to earn, but to protect. The Infinity 9 playbook is 1. We're sponsor agnostic. We don't marry operators, we date them. Local sponsors bring us deals, we underwrite them harder than we do the real estate. If they were to pass our filter, then, and only then, we move. Second, preferred equity for cash flow and control. We target 9 to 10% current pay. No hope-based models. Upside is a bonus. We negotiate terms that trigger control if things drift, not if they collapse. 3. Institutional level stress testing. Most people underwrite these deals like they're fixed income. We don't. We model tenant rollover, local employment shift, worst case scenario rent declines in a Monte Carlo style. 4. Distributed market risk. No hero bets. One deal in Georgia, one in Arkansas, one in Ohio. Each market is sub-institutional, but together they balance out. Our investors are diversified by geography, tenant type, and sponsor. And here's the part that people miss. These small, boring retail deals, they get refinanced faster, they get repaid first because they're simple, necessary, and hard to replace. We've seen them outperform the glossy stuff, not once, not twice. It's over and over. We don't see them on the cover of the industry white papers. They've been quietly printing cash for decades. You just need to lens to see them. Now, you might be wondering, if this niche is so good, what else is hiding in plain sight? What other asset class carries institutional level durability without institutional competition? That's what we'll cover next. This wasn't a thesis from a white paper. It wasn't a conference idea or a back test from someone's Substack. It was a real building, a real deal, real money on the line. And it showed us, again, that flex industrial is one of the most structurally mispriced and behaviorally resistant corners of the US real estate. There's a building in San Diego. We can't name it, that's part of the agreement, but I remember every detail. Not because it wasn't beautiful, it wasn't. It was functional, simple, clean, 13 buildings side by side spread over a few city blocks in the heart of one of California's most supply-constrained industrial corridors. You could drive past it 100 times and never know what it was worth. But I'll never forget the day we walked it. The landscaping was a little bit overgrown, the signage was faded, half of the tenants had clearly outgrown the space, and the other half had no business being there in the first place. But that's not what caught my eye. What caught my eye was this. Every lease, every square foot, every rent roll entry was written by someone who had stopped paying attention. The previous owner was an institutional group that had held this asset for decades. Their strategy was simple: hold, don't touch, don't lose. And it worked until it didn't. Because while they were protecting, the market moved. New tenants came, rents shifted, competition vanished. And what was once a safe became inefficient, stagnant, and soft. That's when we got the call. The deal was quiet, it was off market, but real. We didn't take a passive role, we came in as a co GP, shoulder to shoulder with the operating team. Not as spectators, as architects. We didn't just put money in, we sat at the design table. We looked at every lease, we walked every suite. We saw how 30% of the rent roll was still under market in a submarket where 80% of this exact product type had already demolished or converted into life science. That wasn't a deal, it was misalignment. So we made a decision. We were going to take this building back from neglect, from drift, from the soft comfort of good enough, and we would clean it up, re-tenant it, reprice it, not with risk, but with rhythm. We didn't touch the bones, we didn't overbuild, we repainted, we replaced the HVAC, we added signage, we took a tired industrial park and made it visible again. But more importantly, we structured it. We didn't take common equity risk. We didn't chase some 5-year hockey stick pro forma. We entered at a co-GP level, but with built-in preference, control rights, aligned incentives. Everything designed to protect the downside before dreaming about the upside. That building will exit in just over 4 years. If nothing changes, it will return north of 19% IRR. It will more than double our capital. And every step of the way, we've known that the cracks that could show because we engineered that slab. This is the kind of investing no one talks about because it's not flashy. It doesn't involve a 60-story towers or global tenants or drone fly-throughs. But I'll tell you what it does involve. Local tenants who pay on time, hard assets that don't need reinvention, and a structure that works in every market and every time. That building reminded me of something that I had almost forgotten. That real money isn't made in the pitch. It's made in the quiet discipline of seeing what others ignore and structuring yourself where others drift. And if Flex Industrial keeps giving us those opportunities to own not just the assets but the position, we will keep showing up. Quietly, deliberately, and always from the stack, not from the story. Let me take you to another example. There's a moment in every investor's life when the spreadsheet stops mattering. When the pro forma, the upside, the IRR, all of it gets quiet. And what are you left with is the question. Where do I actually sit in this deal? For me, that moment came in the middle of a multifamily project in one of the fastest growing US cities. The sponsor was sharp, tenured, local. I'd done a deal with him before and it worked. This one was bigger, more ambitious. He wasn't just building a building, he was assembling a block, parcel by parcel, one long bet on one street. It was bold, it was logical, and I believed in it too. But I also knew better than to believe it blindly. So when he asked if we'd come in as equity partners, I paused. And I asked the question I always ask. If this goes sideways, who gets hurt first? His answer was honest. So was mine. So we didn't come into common equity. We came as a preferred equity, structured with triggers, thresholds, everything negotiated before a single shovel hit the ground. We had a fixed return floor, a current pay, and first rights to any free cash flow. Any penalty and penalty interest if milestones slipped. And they did. Midway through construction, inflation hit hard. Material costs exploded. Then the sponsor dragged in a subcontractor lawsuit, delays, draw disputes, capital calls. The common equity, the guys chasing the back end, they were scrambling. But us, we were still getting paid. We had structured it from before the storm. Preferred equity isn't sexy. It doesn't headline conferences or win awards, but it sits where the power lives. It's the layer that says, I'm not here for the lottery, I'm here for the lean. And if things go wrong, and eventually they always go, you're the first line when the dust settles. It isn't a tool for every deal. It's not a hammer, it's a scalpel. We use it when we trust the operator, but we don't know if the plan will work. We believe in the market, but not in the timeline. We see the opportunity, but we want certainty first. It's not just a financial position, it's a psychological one. Preferred equity says, I don't need to be the star. I need to be the steward. And in this stage, stewardship is more valuable than spotlight. We've used this structure now in dozens of deals, in multifamily, industrial, even select retail. Not because we're cautious, but because we're clear. You don't need to control the entire building to protect your capital. You just need to know where to sit. And that's where most investors never learn. They chase the building, not the position. They chase the pitch and the paper. They chase the dream instead of designing the structure. That deal, it got closed. We got paid out ahead of schedule, fully intact. But more importantly, it taught me something. Control isn't about owning everything. It's about owning the right slice with the right terms at the right time. And preferred equity, when structured properly, lets you do exactly that. Quietly, powerfully, and without apology. Next, I want to share something more personal. It's not a deal, it's a mistake. A moment when I thought access was enough and learned the hard way that structure is everything. Because before there was discipline, there was drift. And I want to show you exactly what it cost me. I remember wiring the money. It was 6 figures, my money. No outside money, no LPs, just me. Recently exited, freshly liquid, trying to find the next foothold. The deal had come through someone I knew, not very well, but enough to trust. He was charming, he was polished, said all the right things. The project was multifamily in a market I liked, good location, high demand, clean deck, strong IRR, but I didn't underwrite it. I didn't run a stress test. I didn't structure my rights. I didn't ask the hard questions, the ones I ask instinctively now. Because I thought access was protection, because he was in the know, because I was new to the side of the table and didn't want to slow the momentum. I remember feeling proud when I wired that money, like it had crossed some threshold, like I was finally on the inside. But when the silence started, no updates, no reporting, no visibility into what actually was going on, then came the delays, the excuses, the soft apologies, and then nothing. My emails went unanswered, my calls were returned late, if at all. I wasn't in the deal, I was in limbo. And with every passing week, that feeling grew. That I traded years of sweat, sacrifice, discipline for a position I didn't understand in a structure I didn't negotiate with a partner I barely knew. That was when nausea set in, not because of the loss, though that came too, but because I realized the truth. I had no protection, no preference, no control, no recourse. I'd put myself and my capital at the bottom of the stack, and I called it investing. That experience became a scar, but it also became a blueprint because from that moment on, I made a decision. I would never again confuse access with clarity. I would never again bet on charisma over contract. And I would never again wire into a deal without knowing exactly where I sat, not just on the org chart, but on the stack. That deal, I clawed back some money, not all, not most, but enough to remember, and enough to build everything we do now at Infinity 9. Today, we don't just want to value opportunities, we want to structure relationships. We don't just ask what's the upside, we ask who gets paid first, who controls the levers, and what happens when things don't go as planned. Because at this level, the biggest risks aren't market risks, they're human, they're relational. They're what happens when no one is watching the turns because everybody's watching the returns. And that's what most investors never see until it's too late. If you've ever been in a deal where something didn't feel right, if you've ever chased a pitch because you didn't want to miss out, if you've ever said yes before reading the docs twice, then you already know what I'm talking about. This isn't theory. This is a tuition most investors pay before they learn the language of protection. Let me leave you with this. The smartest investors I know aren't the loudest. They're the ones who ask calm, specific questions before the first dollar leaves their account. They're the ones who structure from clarity, not hope. And they're the ones who know the capital alone is not power. Structure, capital is. In the next part and final part, I'll show you what it means for us, not just for our investors, but legacy builders. Because this isn't about returns, it's about the game behind the game. And what happens when you finally see it for what it is. If you're here, still listening, then something inside you already knows this game isn't what it looks like. You don't need another headline about rates or rent growth. What you need is a new lens. Because most people, most investors, are playing the wrong game. They think they're investing in real estate, but what they're really investing is structure. Two people can sit in the same asset, same building, same market, same operator. One gets paid first, the other gets diluted. One sleeps peacefully, the other loses sleep over delays, distributions, and decisions they never control. The difference? It's not the property, it's the position. And that is the game. And once you see it, you cannot unsee it. At Infinity 9, we don't chase trends, we don't time cycles, we don't sell stories. We build structure. We look for forgotten retail centers in town no one's underwriting. Industrial assets with tired signage but irreplaceable locations. Developers who need capital but who respect discipline more than optimism. And we enter them not with excitement but with clarity. Our investors sit in preferred equity slices, co-GP seats, structured notes, the parts of the stack that aren't on the front page, but are always on the buyout schedule. We don't build portfolios for volatility. We build capital ecosystems that protect, compound, and liberate. And we do it because we've lived the alternative. I've lived it. I've watched money drift away in silence. I've seen deals where access became a liability. And I've learned painfully, patiently, that protection is not paranoia, it's precision. Maybe that's what I want to leave you with. Not a call to action, not a pitch, just this. If the options being showed to you all feel the same, noisy, glossy, exposed, if every deal feels like a gamble disguised as a strategy, if you're tired of being invited but never truly seated, then maybe it's time to stop playing their game and start learning how it's actually played. The institutions don't hope, they structure. They don't chase, they allocate. They don't predict, they protect. And for the first time, you don't have to guess how to do it. You can build your own edge, your own lens, and your own rules. Because at the end of the day, you don't need 100 deals. You need 5 structured properly. And that's how you turn capital into clarity, and clarity into legacy. Thank you for spending this time with me. If it helped you see the game differently, if it gave you language to something you've been feeling, then stay close. We're just getting started.